What's up, traders? I'm Hotshot. I am not an educator. My educator is ICT. For free education, check out his YouTube channel, The Inner Circle Trader. With that being said, this channel and video is for entertainment and my own learning purposes only. This is not financial or trading advice. Please trade at your own risk. Now, this video is going to be a freaking banger. In this video, I will give you the straight formula to never blow a funded challenge again. You will never go in 10% drawdown, 8% drawdown, whatever the funded challenge is. You will never go that far using this risk management plan. And I've created the document right here. I've watched multiple ICT videos to understand that this is the risk management plan that he recommends to follow. Now, with this plan, it's very unlikely that you're going to go in such deep drawdown on the account to where it gets blown. You will never fail that objective following this risk management plan. The only way that you'll fail that objective following this risk management plan is if you are super undisciplined and you are actually risking way more than you should be. With this risk management plan, you can take 16 losses in a row and only be down half on a funded account if it's 10% loss till it's blown. But with this, let's say that it's an 8%, 12 losses in a row. If it's 8%, then it's blown. You could take 12 losses in a row with this risk management plan right here. So to kind of explain it really quick, every trade, we will begin with 1%. If we have a loss, then we're going to cut our risk. So I've created this with examples with the 50K account. Let's say you're going for the 50K challenge. So 1% of 50K, that's going to be $500. So if you lose minus $500 minus 1% total, this is our first loss. You're going to cut your risk. You're going to drop from a 1% risk. The very next trade that you take, you're going to risk 0.5%. You must win back half that 1% loss, which is going to be about 0.5% or 250. In this situation, it'd be a 1-to-1 R. In order to risk 1% the very next trade again, or you're going to be minus 250 on this. In total, you're going to be down 1.5% total with 2 losses in a row, right? If you lose this trade here, you're going to cut your risk again. You're going to risk 0.25% on your third trade. If you've lost 2 times in a row on your third trade, you're going to risk 0.25%. Now, the key to this risk management plan, you really want to pay attention to how much you're down, the percent. Of course, this number varies based off the account and the size, but you want to pay attention to this, okay? The 1.5%. Now, if you're risking on your third trade 0.5%, 0.25%, my apologies, 0.25%, you must win back half the 0.5% loss that we took up here in our trade 2, which would be 0.25%, a 1-to-1 R, or $125 with this 50K challenge example, in order to revert back to this 0.5% risk the very next trade. Or if you lose this one, you're going to be down 1.75% total, okay? And this is 3 losses in a row. Now, here on, we have to add any 0.25% loss to the 0.75% that we lost here and here, okay? So our total loss from the 0.5% plus the previous 0.25% here and here, okay? So I hope you guys are following along with me. I hope I'm not making this too confusing. It is very, very simple, okay? So you want to add that and win back half of that total in order to revert back to that 0.5%. Once you're back to that 0.5%, you must win back half the 1% loss in order to get back to the 1%. Okay, so now trade 4, let's say we lost 3 times in a row. Trade 4, you're going to risk 0.25% again. We must win back half the 0.5% loss that we lost between these 2 trades in order to revert back to a 0.5% risk the very next trade. Or if we lose this one, we're going to be down a total 2%. So 4 losses in a row, we're down 2% on the account, okay? Now you're going to add this loss to that 0.75%. So now we're going to take a 0.25% risk the very next trade again, and you must win back half the 1% loss. Why is it 1%? Because it's 0.75% plus the 0.25% loss we just lost here. So 0.25% risk here on trade 5, we must win back half of that 1% loss, okay? Which would be a 0.5% win or $250 for a 50K account example, in order to revert back to 0.5% risk the very next trade, okay? And it just continues, okay? It continues, and it continues. You can follow this formula. I don't have it written out all the way. I'll continue to write it out. This was a lot already. Minus 5%. I really highly doubt that you guys will take 16 losses in a row. But if you do, you're only going to be down 5% using this risk management plan, okay? This right here will prevent that objective in the funded challenge, the maximum loss on the account. It's going to prevent it from ever getting blown, ever getting taken. You know what I mean? You should never, ever blow a funded challenge or blow any account. You should never ever blow an account again following this strict risk management plan. I'm going to leave this document's link in the comments down below so you guys can go check out the link. It's also going to be in the description, so you can check the description of this video or the comments of this video. And this link, this document is going to be in those sections. You can go check it out. It's going to be for your viewing, so you guys can take this, run with it, implement it, and I can guarantee you guys you will find success with it, okay? I found success with it. I have been so, like, my risk has been so managed ever since implementing this. It's changed my whole way of managing my risk. Really has. So go check this out down below. Now, the silver bullet. Yeah. Today was Friday, April 14th. It is currently 5:05 p.m. where I am. However, the markets are closed. However, check this out for today. So between the 9:50, let me move this right here. Between the 9:50, and of course, this is New York time. If you don't have your time set it to New York. This is 9:50 to 10:10. Within this window, there is a small macro that begins. And this macro, what it does within this time, you will see a run on liquidity. After that run on liquidity, you want to wait patiently for displacement. Displacement happens here, and then you want to identify your fair value gap. Fair value gap right here, boom. Your entry will come in from 10 to 11. That's when you want to be entering. And you can see right here, we entered right here, 10:02, 5 handle stop, 5 handle take profit. Beautiful trade right here. We weren't even in it for 1, 2, 3, 4. We weren't even in it for 5 minutes. 4 minutes in and out. Now you pay yourself as a trader right here. You take partials. So let's say you risked 1%, right? You risked 1%, you're going to claim partials. You're a 0.5% winner so far, and you had 0.5% running. Now you're going to cut your risk. You're going to move your stops from here, and you're going to move them halfway between the original stop loss right here, between the original stop loss and your entry, okay? So right here is our stop. If price wants to come and stop us out, it would be a minus 0.25% loss. So in total, you would be a 0.25% winner on this position if it came and stopped you out there. But it didn't. Let's say that you held for opposing liquidity. Where is opposing liquidity? Well, there's some right here you could take some partials at, right? There's some right here that you could take some partials at, right? And then there's a bunch of relative equal lows right here. You see that? Boom. Let's say that you held for there. This is a beautiful 1 to 4 art. Let's say that you even held for this one. This is a 1 to 1.5R. This one right here, nice 2.4R. Beautiful, beautiful. Now, a lot of y'all are asking, can we implement the silver bullet in Forex? I don't know. Let's go see. Let's go see it real quick. In Euro USD, let me just delete everything on my charts. So let's go to the 10 to 11 right here. Let's see on the 1 minute. Let's see if we see something. 10 to 11. Boom. Now, from 950 to 1010, the macro opens, that begins to sweep liquidity. You can see it right here. Boom. There's a sweep on liquidity, displacement. From 10 to 11, you will get your entry. Here's the 10 o'clock, 10 to 11. Between this window is where you get your entry. And you can see we got our entry right here. It was 10:02. Now with this one, it's hard to do a 5-handle stop on this one. I don't know what kind of stop we should put for this one. It may vary amongst traders. We could even put our stop loss up here above the fair value gap. It'd be about a 13-handle, 13 pip stop loss. And we target 1-to-1. Let's just say we added a 5-handle stop loss on this as well, right? 5-handle stop, 5-handle take profit. You can see, obviously, we weren't stopped out at all. Came close, tapped us in, came real close, and that's actually pretty scary. So on Forex, it's something to back test to know for certain where you should put your stop, how many pips you should put your stop, if your stop loss should be a locked set of handles, pips, however you want to refer to it, pips, handles, I see them the same. It definitely varies upon the trader. I know 5-handle stop, 5-handle take profit on ES is legit. It's realistic. On Forex, I haven't back tested it enough to see, but we can see here that the silver bullet played out very nicely in this as well. Very nicely, the silver bullet. Let's go back another day just to confirm. We go back right here, Thursday, 950 to 1010. This is the macro. This is where we want to see the sweep on liquidity. Here's that sweep on liquidity. Boom. Ran out liquidity here. Displacement. Boom. Now someone asked, why don't you look for the market structure shift? Well, because I was criticized in the past, and it makes sense why I was criticized. ICT does not mention a market structure shift in this model. He says, wait for that run on liquidity, then wait for that displacement. Once you get that displacement, the fair value gap, you take your entry and you target opposing liquidity. For ES specific, it's 5-handle stop, 5-handle take profit, pay yourself as a trader, and do so like that. Now, here, obviously displacement, obviously shift structure. There's no doubt about it. You can see that this was a market structure shift point right here. If you were paying attention to that, this is market structure shift point, right? Now the displacement comes right here. Boom, boom. Here's 1. And here's 2 fair value gaps. Now, shout out to Dark Matter Mike. Homie said, usually if there are more than 1 fair value gaps, he likes to use the Fibonacci, specifically the OTE setup, to know exactly which fair value gap to prioritize entry off of. So since equilibrium is this fair value gap, if we entered right here, it's still considered in a right, because if we buy low, that's discount. If we sell high, that's premium. So it's still considered in a discount in this area. We want to be selling in a premium, and premium is above equilibrium, aka the 0.5% on the Fibonacci. So we'd prioritize this higher fair value gap, and you can see that it tapped it right here. Let's just say we put our stop above this candle right here, be about a 2.7 handle stop loss, 2.7 pips, and you can see that it was beautiful right there. Let me go back one more day. It's happening, y'all. It's happening. So this was the 950 to 1010 macro. We seen the liquidity run, and then our entry obviously came in after 10 o'clock. So that's how you wanna do it. Someone also mentioned that this is also possible to happen in gold. I have not checked out gold yet. Maybe we could possibly do that in this video as well. Let me go ahead and 950 to 1010. This is where we see the run on liquidity within this window. I see a run on liquidity here, but it's not our entry. We ran out liquidity here, ran out more liquidity here. Displacement, we got right here. So it didn't liquidity run, came in right here. However, there is no displacement, right? Then it ran liquidity again. So if you wanted to count this candle, no, you can't count that candle because it didn't run liquidity. So the liquidity run didn't come in the macro. There was a liquidity run during the macro, but it didn't, the one that we're looking for didn't come in the macro. And of course, this is hindsight. If you're trading this live, you might have been looking for an entry after this run right here, right? Now, as soon as it turns 10, right here, 10 to 11, that's the silver bullet. That's where we're going to entry. Right here from this one to this one, this time window right here is where we're going to look for entry. You can see the run on liquidity here, displacement. And here's a displacement down that creates the fair value gap here. Let's say that you're in a seller right there. Boom. Stop loss, 5 handles. Take profit, 5 handles. So it looks like it works in Forex, you guys. It does. And you guys can continue to backtest this for your own viewing, but it looks like it works in Forex. Let me check out gold really quick. Now in gold, let's apply the same times, 10 to 11. Let's see, 950 macro, 950 to 1010. Boom, and then the entry comes in from 10 to 11. Boom, boom. Just like that. Now, move that one just one over. Run on liquidity between this one. No, it didn't run out. It ran out all these lows, but obviously there's no displacement up showing any significant, movement towards the upside, for some buys, but continues to run out sell side. And honestly, I don't see nothing here. Let's see the previous day, Thursday. Let's see for Thursday. For Thursday, go 10-10 or 10 to 11. Boom, boom. Let's see right here. I'm not going to put the 950 on this one. I don't want this video to be too long, you guys, But if you notice, you know what? I am going to put it. I don't care. Whatever. Good value, 950 to 1010. Right here, here's a run on liquidity, and you can see that it took out these relative equal highs from the past as well. Boom. Run on liquidity in this small window, 950 to 1010. That's where you're looking for the run on liquidity. Ran it out. I don't really see much displacement there. However, it did create a fair value gap. It did create a fair value gap, okay? Boom, boom. See here, entry. Now, 5 handles is gonna be way too small here. Yeah, oh yeah, no. See, because this would be like technically like, that's 50. This is 50 handles right here. You want to pay attention to this number. If you're using these tools down here, and I may be wrong, but my interpretation from all my years trading, this is my 5th year trading. I barely discovered ICT in my 4th year trading, which was last year around like June. Right here, this is like 52 pips, you guys, straight up. So if you were to put it like right up here, it's 136 pips, right? 136 handles, if you will. But you can see if you were to put it like above the 1 candle of the fair value gap, like I like to put it above the 1 candle because that's conservative to me, sorry. And if you put it, the fair value gap candle itself, if you put it there, I consider that risky. Okay, so I like to be conservative as a trader, and you can see here, beautiful setup. Looks freaking good. It might be working in gold too, shoot. You never know. Let's see. Let's go to Wednesday really quick just to confirm. And this is going to be my last one. Let's go to Wednesday. 10:10 to 10:50. Or 10:10 to 10:50. What the heck was I just saying? 10 to 11, 9:50 to 10:10. My goodness. I can't talk. Okay. So, honestly, this one was ugly. You know, there was no run on liquidity throughout this area, but it ran out buy side liquidity here. No displacement, ran out more buy side liquidity, no displacement at all. No, I don't see anything. There's displacement here. After maybe you can consider this a run on liquidity, and then maybe you can consider this a run on liquidity. But even then, this is the displacement right here, fair value gap. And you can see that if you would have entered, you would have been just sitting. It wouldn't have even been fun. You wouldn't have even, you probably would have got stopped out if you would have been holding that whole time. But on gold, it doesn't look too well, in my opinion. And that's my opinion. If you're a gold trader, keep up at it. Back test this. I think it works well in Forex. It looks like it does. But in ES, it's a game changer. In ES, it's just unbelievably awesome. But that's going to do it for this video, guys. In the next video, I'm going to be reviewing a couple of indicators, the Lux Algo ICT concepts, as someone mentioned. And there's also another one that someone had commented in the previous video that told me that it's another good one. I'm going to check those indicators out, see if it's something that we can utilize to kind of make our lives easier, especially whenever it comes to trading. So that way our eyes don't miss something that's on the charts that's like very obvious. So next video, be sure to check that out. I also got a Telegram group down below in the comments. If you want to go join it, it's free. There's a lot of value in that group right now. There's about 85 members, maybe even more. And we're just all loving it right now. A bunch of ICT students. It's a vibe. But go check that out. Go check out the dark. I pray you guys pass all your funded challenges and profits to you all. Until next time, hot shot out. Thanks for watching.